every couple of years, the 60/40 is dead. Now the 60/40 is back. It's all a marketing gimmick. At the end of the day, the 60/40 is kind of the original way to diversify your risks.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to the Ducharme Wealth Management Podcast. Today I'm joined by Paisley Nardini. She's a CFA or Chartered Financial Analyst and a CAIA, a Chartered Alternative Investment Analyst. Highly regarded, very professional, and has a depth of industry experience and insight from the institutional side of finance and the way that they think about stuff. So in our conversation today, we talked about just a little bit what's going on in the markets with the volatility, uncertainty, how to think about that, but more importantly, like portfolio construction and how are people positioned and what are some of the things they should be thinking about and what are all these different things that people have access to or are being offered by advisors or invested in, and what are the potential implications of that going forward. So with that, I hope you enjoy the show. It brings us into the whole conversation of today, though, which is, VOO and chill is not a portfolio and it's not a financial plan, right? And there's more thought and more math that goes into, what is a portfolio, managing that, and expectations for the long term, because, equities are not going to print 20, 25% years every single year, no matter how great you think your candidate or politician is or how bullish tax cuts might be. Like at a certain point, it's got to correct and come back to, I hate to sound like the mean reversion guy, but there is sort of a long-term trend in returns of equity markets. And the reason why is because like there's no free lunches. It just comes down to profitabilities of companies, the economic activity, and what that does as a whole.
We get compensated for taking risk. I mean, you don't get paid 20, 25% annual returns without bearing that risk premium. And I think people assume that, 20% return in the stock market comes without risk because it just has been up and up. So like seeing the expectations coming into this year is everybody was like, oh, wait, this is pretty easy. And that's exactly then the inflection point of when people get cut off sides. And that's why we've seen so much vol this year.
Yeah. And it really hasn't even been that bad. On the year, S&P's down. What are we right now? 3-4%.
I mean, that's why like we're talking about this, like markets are turbulent. Like how do we reposition our portfolios? And I think it's less about like, how do you reposition to reduce risk? And it's more about how do you reposition to take advantage of some of these dislocations and opportunities? Because from what we've seen thus far, it's been more of a rotation trade than like a, growth shock. That's usually what, dovetails into a recession. It's more of just like a rotation and maybe flatlining some of the expectations that were pretty lofty.
Yeah, I think like as a technician and I'm watching markets, there's been only a handful of days since the selling pressure has started where you have everything just down on one day, right? Like stocks down, bonds down, gold down, alternatives down, it's like everything's down. Even like, interesting on those days is like, it's like dollar down, stocks down, bonds down. It's everything's down. And to me, like if we really were seeing a market come apart, like that would be more common, right? Because it's just, to me, that's like, it's the margin call, right? Like those are the margin call days. And we've quickly seen the correlations detach right after, right? So, yesterday stocks down, bonds down. Today, stocks down, but bonds are up, right? So you're starting to get that diversification effect across moderate portfolios. I really don't want to be the guy that says diversification's back because there's so many people that are saying that right now. And they're like, diversification's back. International is outperforming this year. And it's like, yeah, but you've been sitting in diversification for, 15 years and you're so far beyond, like you're so far behind because of that diversification that.
But it feels good for the month and a half that it worked.
It feels good for the month and a half that it worked. Well, and so that's the tough part about diversification is how do you build a portfolio that is like going to stand the test of time. And I kind of think the answer is like, in my perspective, you can't, right? You can't say, I found these, blends of, 4 or 5 things, and I'm going to hold this exact asset allocation for the next 40 years, right? Like maybe if you hold it long enough, it always, sort of mean reverts back. So maybe it does work out, but I just don't know that
I
many
think the
investors
problem
that have
too,
that
like,
timeline.
yeah, I think the problem too is like diversification means there's always something in your portfolio that you hate. There's always something that like you're always sacrificing something from an upside perspective if you're
Yeah.
diversifying.
Hmm.
Um, but I also think that when we are constructing portfolios to optimize for diversification, to smooth returns, to, mitigate
Hmm.
drawdown and achieve the highest upside, like it's always in the rear view mirror.
Yeah.
And I think that's like as investors, I mean, there's obviously a lot of behavioral biases, and we're always
Hmm.
looking backwards and saying, like, what existed in this time period, whether it's a 1 year look back or a 30-year look back. And then how do I construct a portfolio based on that? Right. Because that's all the information we have is what has happened and not what is going to occur. And so I think that's where people continuously are like behind the ball on rather than thinking about like where are markets headed, where have they been? And that's how we construct a portfolio. And so that's
Hmm.
why, the 60/40, like everybody's become so comfortable because it worked. We were in a bull market for bonds for 30, 40 years, and we had really attractive growth in equities. And so rather than saying like, okay, but are we going to be in a bull market for bonds for the next 30 years? Our equity, our equity is going to deliver as they
Yeah.
have. So
Hmm.
maybe the 60/40, which again is a tenet of diversification, like maybe that's not the best way to think about kind of holistic portfolio management going forward.
Yeah. So the role that you play at Simplify is to help, you kind of do the strategy allocation across portfolios. Um, maybe give anyone listening just like a quick context background. What have you done throughout your career a little bit, and what are you doing now at Simplify and focusing on? And I think that leads into the conversation of, what are some of the things that we can consider and look at in portfolios when we're trying to build stuff that takes into account forward looking, but also has an appreciation for historical returns.
Yeah. So I got my career started on a trading desk up in San Francisco. I was managing kind of front end, high quality rates, agencies, munis, as well as IG credit. And coming right out of school, I would say like it wasn't the most like kind of sexy career, right? I wanted to be in equities. I wanted to be an analyst and thinking about like individual companies and do a little Gordon growth model and some dividend discount model. But I was trading T-bills and front end rates at a time when rates were zero. So that also provided a really interesting backdrop, just kind of starting my career and understanding just kind of the level of rates at that time. So after 3 or 4 years of that, I decided that, waking up at 3:34 in the morning and sitting behind a Bloomberg screen, there had to be more to life. But what it did provide me was a real appreciation for what it means to understand kind of the backdrop of macro. From an economic data perspective, from a policy perspective, the fixed income markets are massive, and the implications on rates and bonds and credit as it relates to the economy and geopolitics and divergence and interest rate policy globally, like it just really gave me an appreciation of that. And so I pivoted my career to kind of get more in front of clients so I could better understand when I'm managing portfolios, what does it mean when you have to articulate the performance attribution or positioning to our clients? How do they think about that? What are their concerns? And so that then really kind of started this kind of in front of the clients, but also closely connected to our investment portfolios. And so I've spent the last really 8 or 9 years in what I would call more of this strategist role. And that really blends again, understanding portfolios, markets, but also understanding what's most important to clients. Because at the end of the day, if we're just managing portfolios for ourselves, what are we really doing, right? We're here to better our clients' portfolios and to help them achieve their objectives. So as it relates to my role at Simplify, I oversee our alternative suite of strategies. So helping our portfolio management team, helping our clients understand them, helping with positioning. And then I'm also overseeing our model portfolio business, which I think dovetails nicely into our conversation here. How do you bring all these pieces together? We have subject matter experts in fixed income or equities or alternatives or private markets. But at the end of the day, almost every single investor and advisor has all of those pieces in a portfolio. And so, how do we blend them in an optimized way? How do we think about, rather from just an asset class perspective and putting the pieces together, how can we think through the lens of more of an objective based approach? Because as we know, I'll just give one example. Credit. Credit has, higher beta to equity. Does it deserve to be in the defensive sleeve of a portfolio, or is it more kind of growth oriented, or perhaps a blend of both? So you can start to see how asset classes can transcend these kind of these buckets that we label them in Morningstar, et cetera. So my role is to work with our clients and work with our investment team to really put the pieces together and deliver on our clients' expectations from a holistic portfolio management perspective.
So when you're looking at portfolios, do you tend to look at something like a risk parity allocation with forward-looking asset class return assumptions? Do you think there's value in trying to pick stocks or sectors? Do you think how would you just broadly, what's your philosophy?
So I spent, prior to joining Simplify, I was at Invesco for 7 years on our multi-asset solutions team. And I share this because really the bedrock of how we supported our clients from a strategic asset allocation perspective, meaning how do we help our clients build their baseline portfolio allocations, was based on or predicated on capital market assumptions. And I would say this is, again, going to be more of the backward-looking approach, really rooted in that mean reversion, or that belief that the average return of an asset class over time, even though in one specific year you rarely achieve that specific return, but over time that average tends to mean revert. So as we're looking in the rearview mirror, developing capital market assumptions, we're building portfolios for the future, and I think there is merit to that. I think in all instances, we only have historical data. We don't have future data. So we have to work with the information that we have, even if it's not perfect. But what I found is that in reality, when we're building portfolios based on mean reversion, we really have to have a long time frame. So unless you're an endowment foundation, or even some like the large sovereign wealth funds or public pensions, in the advisory space, I mean, many of these clients long term might be 2-3 years. And as we've seen in just the last 2 to 3 years, we haven't seen anything average. So if we're relying solely on backward data and the belief on, mean reversion of returns over time, we might be, disappointed. So I think how do we can then combine the information that we have today? And that's where I think we kind of transition from asset classes and historical average returns to more of like, what are your individual objectives? Do you have a specific income target? A lot of our clients think in the decumulation phase, whether they're in retirement or whatever stage of life, if you know that you based on, your net worth and what your living expenses are, you might have an income target of say 6 to 8% in a given year. Why don't we just find sources of income, dividends, coupons, whatever asset class you're seeking to deliver that? Sometimes we overcomplicate it of like we need X% in bonds and stocks without really thinking about like what are we delivering underneath the hood. And so as it relates to how we think about portfolio construction and multi-asset models here at Simplify, it's really more of like getting into the weeds on like what are we actually getting out of these investments. And I think just broadly, the industry is also transitioning to more of this objective based or outcome based when it comes to investing. Because as we know, in this current market backdrop, uncertainty is high and uncertainty is uncomfortable for everyone involved. And so how can we narrow the bands and really focus on like what are the pure objectives from these underlying asset classes?
Yeah, I think that's just an interesting thing to touch on really quick is the whole like the defined outcomes or objective outcome type investing. There's obviously been the huge rise of buffered ETFs, RILAs, index annuities, structured notes have become wildly popular. And a lot of times these things are like, they're actually really complex in construction. And people don't understand them. I find particularly advisors have no idea how these are really truly constructed and how they'll behave and what the underlying, those like tail risks are, right? Like what happens to the structured note if it really blows up, right? Like what is that, what does that really do to a client if, hey, that they hit that 30% barrier and they thought it was a great deal and it was supposed to be safe. And then, they see that NAV difference, when it matures and they just don't get their money back the same way. Right. But there's a subset of people that will look at that and say that stuff is not good for people because over time you'll have a better return in, buying the index, right? Or just having long only exposure to equities or, XYZ. It's like, don't try to define the outcome because you end up, and this is kind of what they tend to say is they say you're sacrificing some of the upside or you're sacrificing much of the upside, but you're keeping most of the downside. And I think what they get wrong is they're looking in the world of 100% upside, 100% downside. And most stuff isn't that already when you talk about 3 standard deviations, right? Like the S&P 500 is not going to 0, right? Like it's come on. Well, let's be real, right? So
concur.
what's a realistic drawdown and what's a realistic upside? And so if you say, well, how much of the realistic upside am I kind of selling away to get rid of a realistic amount of the downside, right? You can really change that stuff with hedge equity strategies and different things. But the problem that I find when people are looking to that as the answer, right, is that sometimes they can sacrifice liquidity if they're not careful. And liquidity, I think, is hugely important, particularly like when you want to opportunistically rebalance in volatile markets or like life events. You might need access to your money. But what the problem is, though, is the biggest problem is the return is all driven by the same thing, right? So if you get you say like, well, I don't really, I don't like the S&P 500 that much, so I don't want the S&P 500 index fund, but I'll have the structured note that's tied to the S&P 500 or the index annuity that's tied to the S&P 500 or whatever, right? And it's, well, like if the S&P 500 is down, like those things are also going to be down and not giving the return the same way. So something like a structured note might build in a yield component to maybe give you a little bit of return along the way, even if the index is mildly down, right? Like there's sort of ways to do that, but largely in particular, you're like in index annuities, like there's just nothing. You just get nothing. It's like flatline, And so the fundamental difference is like in bonds, for example, you're going to have the income, right? So like even if your bond's down a little bit, you have income and it kind of doesn't matter, what the S&P 500 index did. Like your asset class and what's driving that return is entirely different. So there's that non-correlation, and that's what's largely driven the 60-40 portfolio. But then there's this huge other subset that so many people forget about, which is to me like the third leg of the stool of a portfolio and totally essential. And, I think it's obvious, but if people forget about it, it's alternatives. Yeah. And do you ever hear I'm not going to ask you for your opinion because I don't want to put you on the spot. I'm driven crazy when people say alternatives, and what they mean is alternative. They mean private credit and private equity.
I have an opinion on that. I'm happy to share it.
Yeah, please share it. Because I'll tell you, like my opinion is when you say private credit and private equity is an alternative, I think, it's an alternative to having liquidity. It's an alternative to having transparency. It's an alternative to, having access to rebalance in the major market shocks when you can pick up the alpha on something like that. That's what
Absolutely.
I think.
Yeah. So, that's why we're huge proponents of liquid alternatives. But I also think even in the liquid alternative space, there are still strategies that are, coined as alternatives that have a beta of 0.7, 0.8. So I think And this can mean something different for everyone. I don't want to say there's a single, correlation number or return pattern that should constitute as an alternative. But I think for the most part, if you're pulling away from those traditional sources of capital appreciation and growth and income in the portfolio, meaning stocks and bonds, like the only reason you would is because you're going to either get something better or you're going to help kind of smooth overall returns. So
Mhm.
as it relates to private equity and private credit, first and foremost, there's a reason I think these have been, historically only available to very large institutions with very long time frames. And as we are packaging these and bringing them to the individual investor, there's really an education gap. And I think a lot of these are sold to advisors and individual investors um, as having your cake and eating it too. You now get access to something that, only the largest, public pensions have had access to. And historically, it's delivered 17% annualized return. And there's a lot of marketing efforts behind these. And they also have very high fees. But I think again, almost going back to your earlier comment on the growth of, say, these buffered or defined outcome strategies, I think a lot of what, sells in our industry is a narrative. And people want to understand the story behind them and they want to feel confident that they're going to get this specific
Mhm.
outcome. And I
Yeah.
think the same relates to private markets. We've now seen some private markets come to market in ETF wrappers. I mean, the bigger opportunity and the more the asset flow is and more the advisory spaces in these interval funds. And I sit on an outside investment committee for an RIA, and we're building an alternative model today. And there are private markets within that via interval funds. And there's a benefit to them from having really, I would say, having access to unique parts of the market. I mean, you can get strategies and access to alternative risk premium like royalties or, innovative parts of the technology market. So I'm not discrediting that. But I think what a lot of people don't understand is these things have quarterly gates. And by quarterly gates, that doesn't mean you have to wait for the next quarter to get your capital out. That means every single quarter, a lot of these, you can get 5% of your capital out. And so, as it relates to life events, as it relates to, tactical opportunities in the market, you essentially have to believe and understand that these interval fund type structures are not, you can't access them when you want them. You
Mhm.
have to be patient. You have to be able to say, if I'm investing in this is probably a 3 to 5 year type lockup, even though it has this little sliver of liquidity. And to your point, these are really just smooth beta. And I think the industry is now, acutely aware of this. I feel like there was a little bit of a BS at the beginning of no, it's a differentiated source of return. And it is really just smooth return. And that's okay, provided the client understands that. And as you said, not having access to liquidity, not having access to transparency, oftentimes lagged impacts, as we saw in like COVID, the impact on these private markets and real estate is like everyone was just waiting for the shoe to drop for these to mark to market. And now I was just at an alts conference last week, and several people throughout the conference who were there representing real estate firms were saying, nobody wants to buy real estate right now. It's like, well, of course not. Like everybody, a lot of people got burned. So I think it's wonderful to see institutional investment acumen, strategies, understanding trickle down
Mhm.
as it relates to what I was mentioning earlier, just more objective based approach to investing rather than asset class. That's an institutional way of thinking. I think that's beneficial to the market. I think having access to a more diverse lineup of strategies to build stronger all-weather portfolios, institutional trickling down, that's positive as well. Um, but again, I was speaking with a reporter from Reuters last week who is asking about all these, single stock levered ETFs and such. And I do think they're coming to market because there's an appetite for that. So who am I to say somebody should or should not have an appetite? We just have to make sure that they're used appropriately. And at the end of the day, every investment, the difference between a horrible investment and a great investment can be all about the sizing of it, right?
Mhm.
1% of something versus 15% of something is a very different story. But then the last thing I'll mention too, which you spoke to, is that third leg of the stool. So I think that that's where we've seen growth and kind of this expansion in the last few years with just more alternative diversified strategies coming to market in ETFs. Advisors are now able to build institutional type portfolios that are fully liquid. And again, emphasizing the liquid alternative space. And they're able to do so in a way that I think is more looking forward versus the rear view mirror, like we spoke to. So, like we talked briefly about the 60/40, every couple of years, the 60/40 is dead. Now the 60/40 is back. It's all a marketing gimmick. At the end of the day, the 60/40 is kind of the original way to diversify your risks. And we as an industry are so more advanced than where we were when the 60/40 was first constructed. So like we almost think about it now as like 60/40 might not, it's not dead, but it's not thriving. So like the 50/30/20 as an example is how we think. And that 20% allocation being in alternatives is that third leg of the stool.
Yeah, so I manage a strategy on the TAMP that we're on a platform of liquid alts, and it's not like the benefit from it, in my opinion, is such an easy place to pick up alpha. Like it's relative to, I mean, like easy is a strong word, but it is a lot easier relative to like picking stocks, right? Like I'm gonna pick 15 stocks and outperform the market.
Yeah, that never works for me.
Nearly impossible, right? Nearly impossible. But hey, like gold's trending. I'm going to own gold right now. Like there's a macro thesis. The chart's great. The technicals are good. You can own some gold, right? Manage futures, right? Like it have been a historical diversifier. It's been a pain in everyone's butt for years because they worked really well in 2008. And then since then, they didn't work really well because the market was right. Like the market was just in this huge bull market. And so something that's not keeping up and it's just like, why do I, why do I own this? But going back to what you said earlier is diversification means having something you really don't like. If you like everything, you have a lot of lurking risk.
You got really lucky is what I would say.
And then like different currency trades are like, trading the dollar, which has a historical, maybe a negative correlation to interest rates, right? Or a correlation to interest rates and a negative correlation to bonds. But there's ways that you can pick up these trades in capital efficient manners that they're still liquid, right? And it's not an impossible task. I think if like for me, I do use some other people's work as part of that, some other funds, right? My clients are obviously at this point probably wondering, if they don't know who Simplify is, they haven't checked their statement recently.
Yeah.
I do use some of your guys'
We
funds.
appreciate that.
And, like you have to understand the managers and what they're doing, right? So, not all funds are created equal. And in particular, what I found is in the alternative space, they're wildly different, right? Like an actively managed large cap fund is going to be so similar in reality to another large cap actively managed fund that all have 300 to 400 stocks, right? Like,
yeah, because most of them are usually constrained from like a tracking your active risk budget.
Yeah.
And so, yes, they're out picking stocks and they have their, expertise in their area. But most of those kind of legacy kind of active mutual fund type strategies all have similar levels of tracking error. So you can only get so cute in how differentiated you are. Whereas alternatives are absolute returns type strategies.
Yeah.
So you're really just looking at outperforming cash, upside, downside, long, short. So definitely more of an active risk budget, which to your point just means higher dispersion than across the space.
Right. And that at times can cause uncomfortability in a portfolio, right? When you're I like the way Corey Hofstein, he says, he's like, non-correlation doesn't mean inversely correlated, right? you can have two things that are non-correlated and they can be going down at the same time. They can be going
Yep.
up at the same time, but the drivers, what drives that, is not the same. So what's driving one thing to go up isn't the same thing driving it. Now they both might be going in the same direction, but over time they're not going to act and behave the same way, right? So when you experience a negative side of that, right, your diversifiers are going down the same way as your equities, like the same day.
Mhm.
It feels like extra uncomfortable because you're like, what the heck? I thought this was going to, but that's where you do have to zoom out and say like, okay, I've got a well-constructed portfolio. There's a reason why I own these things. And it's time to just stay the course a little bit, right? Like you got to just stick with the game plan and not get too trigger happy. Right?
Yeah, because there's plenty of instances, and we saw this even in the latest sell-off in equities in mid-Feb, that a lot of these strategies might take a day or two to reposition, especially if they're dynamic and tactical. Especially if we're talking about trend following in the initial days of kind of the sell-off, like it takes a little bit for these to pick up. So if we do have these kind of short-term dislocations that are short-lived, we might not see some of these strategies behave as expected. So back to your point is like kind of sticking the course, understanding that again, like we get compensated via returns for taking on risk. Risk does not mean you're comfortable. It doesn't mean you're cozy. And I think that's the risk anytime we're investing outside of cash in the marketplace. And the other thing I might mention, just as I say the word cash, you alluded to the fact that, alternatives, kind of an unloved part of the market for much of the last 10 or 15 years. And, equities ripped higher, bonds performed well up until 2022. And really why we're so constructive on alternatives today. Maybe we're biased because we're an alternative firm, but we just launched about 4.5 years ago, coinciding with what we think is kind of what is a bull market for diversifiers. And I say this because it's really difficult if you're running an absolute return strategy when your benchmark is cash plus. If cash is at zero, you're already kind of behind the ball when it comes to keeping up with other parts of the portfolio. So I think today's environment of higher baseline for cash rates provides kind of this nice boost to some of these absolute return strategies out of the gate. And as it relates to, say, managed futures, as you spoke to, that was a big reason why in the post GFC era, I mean, there was obviously minimal volatility because there was so much monetary support going on. It was really stifling any of the volatility in the markets, but also because cash was zero. And so now that we have cash at, 4 to 4.5%, some of these strategies, the underlying funding rates for these are just far more attractive. And so that's why we've seen, and starting in 2022, this kind of resurgence of the alternative space and why we've seen so many new strategies come to market, because it finally makes financial sense and it makes sense for investors from that holistic portfolio perspective. So again, like bull market for diversifiers. And I also think too, going back to some of my initial comments, is when there is volatility, there is opportunity. And so a lot of these strategies that you spoke to, whether it's currency strategies, equity long short, trend following, there's dislocations in the market that provide a really ripe backdrop. I actually spoke to Bloomberg yesterday on this, as they reached out wondering about alternative risk premium and why it's done so well this year. And I mean, you dig into it and you're looking at exactly those asset classes you just mentioned, whether it's commodities or long short or trend. And so all of these are now kind of firing. It doesn't mean that it's just a straight line up. There will always be volatility in these, but they're starting to make sense in a broader portfolio again. If volatility continues, as I think you and I both agree it is likely to for the foreseeable, that provides a lot of attractive opportunity for these alternative, especially liquid alternative strategies, to find these dislocations and take advantage of them and produce really attractive returns while also providing the kind of the primary objective in a portfolio, which is diversification, low correlation. And again, that isn't visible in a day or a week, but over the course of a quarter or a year, it starts to make a lot of sense alongside stocks and bonds.
uh, I refuse to say diversification's back because it's just a goofy phrase I keep seeing. But well built portfolios, thought up, good thought, paying attention to asset allocation, navigating markets. I think that's a skill set that's back. I think the days of buying some actively managed mutual fund and having 17 different mutual funds in your portfolio and feeling diversified is going to be a painful ride the next decade for a lot of people. And there is a huge list of reasons why, if that is what somebody's experience is when they look at their account statement right now is a bunch of actively managed mutual funds, is like, you desperately need a second opinion.
Yeah.
But time will tell. I could be wrong, right? I don't know.
Yeah, we all could be wrong.
I could be
but
wrong.
No, I'm with you. I think they're even beyond the alternative sleeve of the portfolio. I believe strongly in the importance of active management, and not for the reasons that historically many people want active managers. Historically, I want an active manager who's going to go out and find the best stock, and it's going to return, it's going to be a 10 bagger, and like the fund's going to kill it, and we're going to be in the top percentile of our peers. I think we're in an environment now, especially we've just had some of the best historical years for equity returns. I think it's less about like, how do I outperform in the upside and how do I protect on the downside? When we go through these environments, whether it's a 5% drawdown or a 25% drawdown, am I invested in a strategy that has risk mitigation embedded within it? In order to have risk mitigation against pure passive, you have to have some form of active, whether it's discretionary active, whether it's systematic active, and really thinking about like, how do you cut those tails? How do you smooth returns? And I think that's the mentality shift that I've started to see. I think, to your point, there's still a lot of people that are focused on, okay, we had 25% returns last year. How do we get 25% this year? We should be more thinking about like, how do we make sure that when we see these pockets of vol, we're going to be better off because we're going to navigate that better than some of our peers.
Yeah. I think the other thing too that a lot of people don't pay attention to, and I found it to be a really interesting portfolio, just a lens to start thinking through, is just capital efficiency in general, right? And thinking that institutional mentality, right? Like, how do you bring that institutional mentality down to, the average investor that, like I work with primarily mass affluent and high net worth people, I'm not working with institutions or ultra high net worth. It's like average people's retirement money and stuff. Right. And so boiling down that, like, what's the way that PIMCO thinks about it? What's the way that the, big pension funds or the big endowment funds think about it? And what are they doing to smooth out those returns so that they can provide that pension benefit to, their people? It's like people's retirement it's their own personal little pension. Right. So
exactly. It's really the same philosophy. I actually had a conversation last night with a sovereign wealth fund who has about 90% of their assets in beta equities. Not just passive, but beta of one type exposure. And the conversation was around, how can we introduce diversified sources, low correlated assets, but through a capital efficient lens? And I do think, and I mean, you mentioned, Corey Hofstein, I think AQR just launched a bunch of these kind of capital efficient type strategies as well. But it allows investors, as you speak to have some of this institutional portfolio construction embedded, of like having your cake and eating it too. I think that there's always things to be aware of, right? Anytime there's capital efficiency, that can often mean that there's underlying leverage. And so you're getting more exposure than you're putting down cash for. But most of these are constructed in a way that's really focused on diversification, more on like, how can we lever up a portfolio? The capital efficiency term, right, is just used interchangeably. So I do think that's another way to think about getting more out of your portfolio. And for many advisors, it's difficult to introduce some of these alternative strategies to their clients, and you see them as a single line item. And as we said, diversification means there's always going to be a line item that you have to explain to someone And it's not going to feel good when that one line item has underperformed the other parts of the portfolio. And then to tack on top of that, trying to explain something that is probably well beyond the investment acumen of the person you're having to explain it to, meaning your individual clients. So I think some of these capital efficient structures allow you as an advisor to do what's best for your clients and have diversification, but have it be a more smooth approach and be able to maximize kind of the allocations across the portfolio.
Yeah. Yeah. It's an interesting world out there. Active management. I'm with you. I think there's a place. I think what good active management means today is just wildly different than what active management meant in the past. I think that was a really good call out. Like the Peter Lynch model is not the active manager you're looking for anymore. But somebody that understands how to, use some professionalism and guidance and marry, somebody's emotional capacity, behavioral tendencies and biases, and then marry that with the professionalism of understanding capital markets, capital efficiency, what drives returns in different asset classes, what are the underlying and hidden risks, what are the return potentials, and get something that works for the clients to get them to their end destination. Yeah. And that may look like less return than the equity markets if the equity markets just do really well, right? Like the last couple of years, and sometimes it looks like getting somebody a really nice return when like it's a bear market, but it's because you were just not participating in equities the same way, right? And so, you got to zoom out and remember, like, it's your game. You got to play your own game.
Absolutely agree with that.
And a good advisor or good active manager can help you do that. So that was a really good call out.
I think maybe the last thing I would say on that too, like as we're talking about the evolution of what active means beyond just like upside downside capture, I think too, like this shift towards more systematic active management, right? Mm-hmm. This rules-based process for security selection or credit selection.
Yeah.
I think that aligns kind of back to our comment earlier on investors wanting certainty. I think that there's something comfortable about knowing the objective of the strategy, how that investment strategy is achieving it, the liquidity and transparency you see on a daily basis. And for example, if you're thinking about like factor tilting, if you're investing in more, small cap or value, precisely on a daily basis, just looking at the markets, how that fund might be behaving versus, a legacy active discretionary manager. It's all stock specific and it's kind of opaque as to what type of exposures you're actually getting. So I think that's a shift too, like whether it's the buffered funds or more defined outcome or more systematic strategies, is it's just giving more information to the investors in a more timely fashion. And reducing some of the uncertainty around what they're actually getting in their investment strategies.
Yeah. I think we're coming up short on time.
Yeah.
But now you put something in my head that I'm like,
let's go.
Gotta get it out. Okay. So the whole thing between systematic, right? Like just a full rules-based approach. So it might be active, but it's like, hey, it's rules-based. We, this triggers, we rebalance, or we rebalance every month, or we do, like we don't deviate from our process at all. And it's rules-based. There's no human element, whatever. And then you have the people that are on the other end, like what you call like the legacy active manager, hey, we get together once a week as an investment committee and we, go through and pick stocks and rebalance a portfolio accordingly or whatever. And so it's like fully discretionary. So it's like kind of like fully systematic or fully discretionary. And I think there's a lot of value in being in the middle.
1000% agree. I can give you an example as well.
Well, like, I think you're going to like the example I've got, is if you look at some systematic stuff, like let's call like managed futures, right? That is generally almost always systematic.
Yep.
And from 2009 on, it was like a pain in the butt, didn't work really well, but you had to follow the process. And so if you're somebody that's like, I'm dedicated to only the system and I only do this. And even if I'm able to look at the market conditions and say, I don't think this is going to work in the next 3 months, or I don't think this is going to work next year or the next 5 months, you're stuck. You can't change. You have to be able to push the brakes on that. And so like, I think like one of the coolest trades I ever like have really seen was Mike Green's pickup of going long vol in 20, end of 2017. And then, he's long vol for Volmageddon. And,
Yep.
that was like, anyone that wasn't around for that, Peter Thiel's, I can only imagine the smile on Peter Thiel's face when Mike, told him the good news, but it was like, everyone thought Mike was crazy, for a minute. Not everyone, but like so many people were on the other side of the trade. And he's like, this is not going to work. And he was looking
Most
at the
good
market.
ideas are crazy at the time.
Well, he was like looking at the market and doing the math, using his experience. And he's making that discretionary call of like, hey, this cannot like what is going on cannot work. It has to blow up. I can bet against it. I can make this discretionary call. And had he been like, oh, I only do it though if my signals fire off to make me get in the trade, he would have completely missed it. Right. Even though he knew it was happening. And so I think just being that person in the middle, that like you have an appreciation for systematic stuff, but you also understand that there is opportunities in the market where you can take advantage of something and, tactically take advantage of it.
I think it's so important, having grown up in the active world for fixed income, from stock or from security selection, credit selection, et cetera, and seeing the value of that in fixed income. And then shifting over to more of an equity-centric role when I was at Invesco, who's one of the leading providers of smart beta. And many of the smart beta equity strategies on the marketplace, irrespective of the manager, are entirely systematic, entirely rules-based, to the extent that they're codified into an index. And so there is no deviation. And if there ever needs to be, it's a full committee process. It goes out for public comment. So let's just consider like those are locked and loaded. We're not touching those. And I think the industry now sees the downside of that. And I mean, whether it's factor investing or other rules-based strategies, like you said, is you can be a manager watching your strategy every day and have zero control over it, despite seeing how rapidly our investment industry is evolving and the markets are evolving. You cannot interject. Mm-hmm. And so that also means then you can't protect the portfolio on the downside either. And I think a lot of rules-based systematic equity strategies in 2023, especially, and then 2024 with like the market concentration, the breadth of anything that was non-market cap obviously meaningfully underperformed. And so that's why I think too, now we're almost shifting back. We started discretionary active, we went to passive, and then we went to smart beta rules-based. And now with active ETFs coming to market, you can have a little bit of kind of the cake and eat it too, from the sense you can have a rules-based strategy with someone who has oversight, that has the ability and the construct of whatever the vehicle is, let's just say an ETF, to interject, enhance the strategy, reposition as need be, with the baseline that there is a rules-based process to it. And that's a gray area, right? That's not black and white. But I do think all these active ETFs that are coming to market are just the new age version of the discretionary active manager, that have a little bit more guardrails and transparency around how these strategies are achieving their objectives. But somebody's, got their hand on the wheel in case we start to veer off the road.
Yes. You got to keep it between the ditches, as my dad always says. You can't. Yeah. That leads into a whole conversation about max drawdown and the effects of that. But we will save that because
that'll be for episode 2.
Yeah. I was thinking this would be a 30-minute episode, and we've gone an hour, and I feel like I have 100 more things that we could talk about and keep going. But you are incredibly busy. I've got a stack day, so we'll have to.
This was fun. No, I appreciate that. Happy to come back. I could talk for hours. I know you could as well. We share a lot of the same ideas, and also some conflicting ideas too, which makes for a great conversation. So thank you for having me. Yeah, absolutely. I'll maybe I think the episode that I really want to get filmed at some point is having Mike on and talking systematic investing and passive flows. Let's do it. Mike would probably be more than happy to. Yeah. He's writing a book right now. Yeah. I've been reading his chapters as he releases them. The greatest, what's he calling it? The greatest lie ever sold. The greatest story ever sold. The greatest story ever. Yeah. Oh, yeah. 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 Same. Same. Yeah. I just filmed with Jim Bianco last week. Oh, awesome. Yeah. He's awesome.
Jim's great. But at the end, he was talking like capital market. We were talking like some capital market assumptions and stuff. And I'm like, how does this tie in with like, I'm like, because what Jim's saying like all makes sense, but also like the whole stuff about passive and structural support for the passive indexes and the way that distorts returns. I'm like, I don't know where those start to intersect, you know?
What perplexes me most, I talked to Mike about this actually just this last week when we were in Vegas together for Exchange Conference. But at the end of the day, I think most people, not all, but most would agree with Mike's research.
Mm-hmm.
I think most people have seen it occur, you know, firsthand. The question is not whether or not you believe in it or you agree. It's more like, okay, but what?
Yeah. What do you do now?
And I think, I mean, just in my conversations with Mike, I mean, you would be silly to fight it, right? I don't think he's saying like, you know, throw passive out the window, but there needs to be some kind of regulatory oversight and the implications of this.
Yeah.
And so that's more, I think, like the call to action from his perspective of raising awareness so that it's on people's radar, so that hopefully we can avoid this catastrophic, nobody saw this coming, which I think is really awesome, right? It's oftentimes when people have a strong message like that, the goal is to get people to invest or buy something that they're pitching.
Mm-hmm.
And at the end of the day, like it's purely to help the industry avoid and catching people, you know, entirely off guard. And through that, there would have to be regulatory changes, et cetera. I don't think it's as simple as, you know, the rotation trade out of, you know, Mag 7 and Mega Cap is going to cause this, you know, shift, and
no,
you know, we're going to be fine. So more to come, but I don't know if I hope he's right or I hope he's wrong.
I think he's absolutely right. In his research, I listened to all his research, and then I've gone and read every white paper he's referenced in all of his research.
Yeah.
And I think
let's get him on the show.
I think he's absolutely onto something. I agree with you. It's just like but now what? Right. And now what? And so what do you do about it? And that's the big question. Right. So anyways, well, hey, I appreciate your time. And thanks for coming on. We'll get you guys back on. I love working with you guys, and always great stuff going on over at Simplify.
Yeah, no, thanks for having me. And we're always here if we can answer any other questions for you.
Thanks again, Paisley.